Welcome back, everyone, to Money Show's virtual expo, Money Markets and Monetary Policy. We are pleased for this next presentation. It is Tim Melvin. He's a 30-year plus veteran of financial markets. He's also the editor of the 20% Letter. Mr. Melvin uses rigorous quantitative analysis based on the principles used in deep value and private equity styles of investing to help investors compound their wealth using strategies designed to maximize profits and minimize risk. He uses in-depth research efforts to uncover special situation opportunities that can profit regardless of market direction. Tim, thank you so much for being here. It's all yours.
Mark, thank you very much. I'm really excited to be here. This is the first time I've done a presentation with the Money Show, and I'm really thrilled to be here. Now, we picked this topic, believe it or not, in February, before all of the current bank madness actually came to pass with everything happening at Silvergate and at Silicon Valley Bank, and then ultimately Signature Bank of New York. All of that was not even a rumor or a suspicion when we chose the topic. I've always been deeply involved in bank stocks. I think they're one of the most overlooked compounding machines on the planet when they're purchased correctly. Of course, the topic is now even more timely because everything that we weren't thinking about in February has in fact come to pass over the last 6 weeks, and bank stocks have been very much at the top of almost every market and economic conversation. So now, rather than scaring me off, as it seems to have done so very many investors, it's actually made me even more bullish than I was already on bank stocks as 2023 began. So let's just kind of jump into why I think it's time to be super bullish on bank stocks, and why, I'm going to share 3 ideas with you today that I think are fantastic long-term compounding machines that can make you an enormous amount of money from just plain boring old bank stocks. But let's just jump in to kind of what's going on in the industry and what I see happening. So let me see if I can get this thing to page down. There we go. These are all the headlines that I saw over the course of the last month. 20 banks sitting on potential security losses, 200 banks at risk of collateral failure, a new bank panic. Shark Tank, Kevin O'Leary, this is my favorite one. Kevin O'Leary came out and said small banks will not be around in 24 months. They're all going to zero, which I love Kevin O'Leary on Shark Tank. That's just such a ridiculous statement. For all small banks to actually go to zero, the entire economy of the United States would collapse inward. Then we've seen the headlines about 80% of all commercial real estate loans being on the books of small banks. That's been a big one. Moody's came out with a report today and said, guys, stop it. It's really only 13% of commercial real estate loans that are on the books of these regional banks. So everything has been blown up like banks were going to end and that this was going to be a 2008 style banking crisis, and you needed to get out of all of your bank stocks and never buy them again. And there was going to be a huge run. If you remember the discussion, all the money was going to come out of all the small banks and go to the big banks, and the small banks were going to zero. It didn't happen. It never even came close to happening. Now, one of the other stories that, market crises and events, they tend to generate instant experts, or what I like to call them. And we had them here. Everybody put down their artificial intelligence certificate that they'd just been awarded prior to the bank headlines. And they put it in the closet with their virology and epidemiology degrees they gotten back in 2020 and became banking experts. And all of a sudden, the biggest concern, what everybody had to worry about, was the fact that there are a lot of uninsured deposits in the U.S. banking system. This apparently came as a shock to a lot of folks, and they were just totally shocked to find out that there were uninsured deposits in the U.S. banking system. Now, FDIC insurance is good on $250,000. Everything over that is in excess of the insurance limits, and in the event of a serious bank run, in theory, they won't be insured, they won't get paid off. In bank runs before 2007, that actually happened. Continental Illinois, comes to mind, and some others where uninsured depositors actually did not get paid. In the world we live in today, not paying the uninsured depositors would have been a problem, a huge problem, back in the great financial crisis of 2007 that basically lasted, guys, if we're honest about it, up to about 2012 was when it really looked like the banks finally came out of the other side. During that time, somewhere right around 400 banks actually failed. They were just gone, merged into other banks. The FDIC did assistance on a whole bunch of acquisitions. Private equity funds stepped in and actually were able to take significant positions in banks. It was kind of, to be honest, a fun time to be a bank stock investor, because if you could pick the winners from the losers, a lot of money got made. But as bad as that was, and that, by the way, was almost as bad as it gets. That's in 2020, or about as close to a 1930 styles depression, are as close as I ever want to be. There were excesses on top of excesses in the banking system. You had banks levered at 30 and 40 to 1. You had just ridiculous loans throughout the system. People were doing whatever it took to get an extra 100 basis points of return. And everybody was basing their lending and credit models on the fact that real estate could never go down. Real estate could go down. It did go down, and all of the foolishness was exposed. And we walked pretty close to a 1930s style collapse. Don't ever want to see that again. Probably will, because that's how banking and the economy works. But no, not one, not a single dollar was lost by any depositor, insured or uninsured, in the United States. Now, uninsured deposits, this is just, kind of where we are right now. They peaked in 2021 at about 49.2% of all deposits in the system, $8.6 trillion worth of uninsured. There's 17 to 18 trillion of assets, which again is why I get so aggravated by people talking about 60 million in deposits left. Yeah, so what? It's not a really big or meaningful number in scope of how big the U.S. banking industry really is. But uninsured deposits have always been with us, guys. These are not new. As you can see, 2019, we were about 44% of all deposits, had about 5.6 trillion of uninsured. That went up. Remember, we flooded the world with money right in here, in the form of PPP loans, in the form of direct checks sent to millions of Americans. A lot of cash came into the banking system, and a lot of it was uninsured. This is, as I said, this is not new. It's been going on. Deposit insurance was invented in 1933. I'm pretty sure we've had uninsured deposits in the system since 1933. This slide, guys, I'm sorry, I couldn't blow this up any bigger without ruining the slide, but this is from the FDIC, going all the way back to 2002. Domestic deposits in the banking system were $4.9 trillion, almost $5 trillion. And you could layer foreign deposits on top of that. This is commercial banks, so this would have been some savings and thrifts as well. But so let's call it right around $5 trillion. Insured deposits were about 3.3 trillion. So there was 1.7 trillion of uninsured deposits in the banking system. They've been with us forever. And what you have to understand is that most of the uninsured deposits, particularly in community and regional banks, are transactional accounts. They're not the big CDs and certificates of deposit. There's some of that. I'm aware of that. But most of it is transactional accounts. They're large corporations, checking accounts, payroll accounts. Several banks have huge municipal checking accounts that, and their payroll, the city's paying their bills out of it. Those accounts aren't leaving insured or uninsured. You're not going to put, the city of New York checking account in a Vanguard money market fund. It ain't going to happen. It's going to stay in a bank or spread across a bank. Increasingly, what this has done is services like Intrify or Magnify Cash that now they'll take all your money. Let's say you've got $4 or $5 million and you want it in FDIC insurance. It is a pain to go from bank to bank. You can go to one bank that deals with one of these services and they'll do it for you and spread the money around. So I think those services will see a boost coming out of this, but uninsured deposits, they're still going to be there. Large transactional accounts are part of the system. We are going to see new regulations come in, and I think increased insurance limits across the board are on the table. And hopefully somebody is intelligent enough to stand up and say what we need here, is drastically increased limit on transactional accounts. Very little risk to those accounts. Hopefully that happens. We'll see. I'm not a regulator, and they didn't call me last time. I don't think they'll call me this time either. I'm going to do an occasional quick time here check, guys, because I'm long-winded. It takes me 30 minutes sometimes to say hello. So, and I'll also issue my blanket apology. I work from home, in case you can't tell by the really terrible decor behind me with my Rat Pack poster and all that. I have a couple of large dogs who are convinced that their major mission in life is to let me know if there's a delivery person within 1,000 yards of the house. So if you hear the dogs, I apologize. The other thing that the instant experts came out, and this really aggravated me, move your money to the bigger banks. You got to get your money out of those small banks where all the big risk is, and everybody's going to walk out. And the securities, they're going to change the rules on how you account for securities and make them take that hit against regulatory capital. Again, foolish, would have totally collapsed the banking system at every level from the top all the way down, and we'd all be, working apple carts right now. But should you move your money to a bigger bank? The answer was no. These are headlines. Bank deposits, big bank deposits rises, small banks see outflows. That lasted for about 6 hours. Regional banks seeing flight of deposits. None of this shows up in the Federal Reserve numbers. Okay, when you look at the H4 and the H8 filings, the small banks were not at the Fed windows doing massive borrowings, and we just didn't see the deposits leave in the kind of numbers that the headlines were talking about. Now, here's something interesting. If you're going to move all of your money into a bank to increase the safety, then you want to go where the most insured deposits, particularly if you're under 150 million. These are the banks, if you're over, 250,000. These are the banks that are going to have the most problem. If you have a large percentage of uninsured deposits, you'll probably have a bigger problem in the event of failure than those who have mostly insured deposits. Guys, the bigger the bank, the lower the insured deposits percentage is. Citibank has like 15% of all of its deposits insured. Does that make Citibank risky? No. It means Citibank does business with a lot of big corporations and municipalities, and they have a lot of large transactional accounts. However, if FDIC insurance was your concern, the smaller the bank, the higher the percentage of insurance that existed across their deposit base. The instant experts were, as they so often do, giving you exactly the wrong advice at the wrong time. So I'm going to try to move through this quick because I don't want to lose the time, and I'm going to do that if I don't hurry up. This is KRA, the S&P Regional Banking ETF. You can see starting in March, this thing had tracked sideways through the year. We were already down to the point where they were trading at 10 times earnings and less, a fraction of the S&P 500's price to earnings ratio. Proceeded to get absolutely slaughtered. Regional banks came off in a quarter by almost 30%. Year to date, they're down about 27. This obviously is as of the other day. We recovered a little bit since then. This is the First Trust Community Bank Index Fund, all the much smaller banks. Again, believe it or not, the smaller the bank, the lower the risk for the most part. And that comes to the trading of the stock, how profitable the bank is, how much capital they have. I mean, you can measure this in 1,000 ways, and almost each and every time the smaller banks are going to come up as safer than the bigger banks. It's one of the reasons that I am a big investor and proponent of investing in smaller banks. But they're still off year to date, over 20%, down almost 30% off of the highs, as everybody everywhere dumped bank stocks. Now, the community banks, even in the worst crisis, they tend not to see the level of selling that the regional and money center banks will. They have more loyal shareholder bases. The insiders tend to own a lot of stock. A lot of them have employee stock ownership plans that own a lot of stock. Local business people, community leaders, and high net worth people in the regions that the bank operate in tend to own a lot of stock. Then there's people like me that are bank stock specialists. And there's even out there, thankfully, some bank stock activists that will take large positions, and they're not going to sell just because the market pulled back. They're like me. They tend to buy on sale. If the market pulled back, they're buyers, not sellers. So then the deposits, oh my goodness. And, there is the competition for deposits. Let's not fool ourselves, right? Banks are always too late. They don't move fast enough. They take too long to raise the level of interest rates to compete. Money markets have done real well, have attracted a ton of money. This is banking deposits over the last decade. Here's the 2020 big spike up. Here's where we are as of the end of March. This has actually gotten better, not worse, since. We're down 3.3%, which is a big number. It's one of the biggest, drops in a short period of time in history. It's not meaningful. It's not going to wipe out the banking industry. The amount of deposits in the system is still much greater than 2019. The headlines want to scare you. Don't be scared. The money came out. It's completely consistent with every other rate hike cycle of my lifetime. Banks take too long. This is small banks, by the way. You can see it's a little sharper and a little quicker. It's still not a huge number. It's about 5% off the peak. And again, a lot of that is reversed and is already back in to the small banks. So here's what's going on. Now, this is from Yardeni and Associates. The previous charts, guys, by the way, a lot of those were from FinViz and BankReg data. FinViz and BankReg data we use a ton, and their charts will be heavily represented in our slideshow because I am my own graphics department and terrible at it. So I use other people's. This is from Yardeni Research. Their weekly research is some of the best economic research on the planet. Forward PE is 7. That is a relative PE ratio of 0.5 relative to the S&P 500. It's dirt cheap. A lot of people I did talk to during this crisis. Again, checking time. Okay, so far so good. We got about 10 minutes left. Banks are dirt cheap, trading below book value in regional banks, a forward PE of less than 8. There's plenty of capital still in the region, still in the industry. If you look at the tier 1 capital ratio, way above regulatory limits at over 14. No credit problems in the system to speak of. Non-performing assets are 0.30%. This is as of the end of the year. These numbers are going to go up a little bit this quarter. You're going to see tick ups in auto loans. You're going to see tick up in credit cards. Non-performing loans across real estate and commercial and industrial, they're going to stay consistent this quarter. We'll get tick ups as the year goes on because as the Fed finally confessed, a recession later this year, early next year is pretty much inevitable at this point. However, you're not going to see terrible credit conditions in the bank just because since the great financial crisis, banks have been awfully selective about who they lend to. If you didn't have a large down payment or qualified for Fannie or Freddie, you didn't get a mortgage. If you do not have a very high credit score and a great job, you didn't get a personal loan. If you made a small business loan, you signed as an individual as well as a corporate officer. Banks really de-risk their loan portfolio. Non-performing assets and non-performing loans will go up, not dramatically so. The 2008 is not going to happen again. There's not enough leverage or stupidity in the system. Now, consolidation tailwind. I've been investing in banks since the savings and loan crisis back in the 1990s, guys. The number of banks has gone from over 15,000 in the mid-1980s, as you can see here. And this doesn't count thrifts and savings banks. So it was actually about 18,000. Steady decline in the number of banks. And no, they didn't go to zero. They got taken over. Okay. It makes sense for large banks to buy small banks. It's the best way to grow. Taking out that 30 to 35% cost save is a powerful tailwind. And it's just, the number of banks, sorry about that, coming down, took this again directly from the government files. That's why they're as ugly as they are. And you can see, look, it's been steady. It's been year in, year out. We get more takeovers. We're about to see this accelerate. The reasons to buy a bank: scale is number one. The larger the bank, the higher the valuation. Why else to buy deposits? This is getting ready to be big. Remember those smaller banks with the large percentage of insured deposits? Those tend to be sticky, loyal deposits. That's going to drive some consolidation to expand geographically, to expand technology and digital services, and to diversify your loan book. If you're full CRE, you can add some single family. Why sell? Keeping up with digital banking, that's a big one. Growing cost of regulation. If you thought it was bad in February, wait till you see what they have for you in the rest of this year. The banks, the industry did with what happened. The door got open to the regulators. You leave the door open for the regulators, they will walk through it. There will be more regulations. That cost is going up. And frankly, sometimes at that size, you can't gain the scale. So it is hard to provide shareholder returns. Then there's succession. Guys, this industry is terrible at succession, finding management to come in to take over from founders or current management when, the hot degrees, they're in technology, they're in investment banking, they're in private equity, they're in venture capital, they're not in community banking. So succession has been and always will be an issue. Sometimes it's just as easy to sell the bank, cash out, and move on. The average age of a bank board member is getting up there. It's over 60. So is the average age of community bank officers, moving higher year by year. So succession is a huge part of bank M&A. All of this is going to accelerate in the second half of the year. Buyers and sellers, consolidation tailwind doesn't go away. I hope to God Kevin O'Leary is right and that all the regional banks cease to exist in 2 years, because they won't go to zero. They'll get taken over. I own a lot of them, and they're going to get taken over at this massive premium, and that's going to make me really happy. So anyway, 3 banks that I think that you ought to be buying right now. And I'm going to try to leave a few minutes for Q&A. So we're going to go through these pretty quick. So write it down. A trust company, Trustco Bank, TRST is the symbol. It's out of Glenville, New York, which is up near Albany. Branches all over New York State, one in Vermont, one in Massachusetts, and where all Northeastern money seems to end up these days, a bunch of branches down here in Florida, right at the $6 billion mark in assets. You look at the bank, $583 million market cap. Again, I love smaller banks. Down about 18% year to date, a 4.6% dividend. Earnings will be down this year. Not going to sugarcoat it. Be down probably 10 to 15%. The estimates are saying 327 down from 393. You're still at a single digit PE ratio of depressed earnings. You have a price to book ratio in here now of 0.98. So you're trading right around book value. The bank's super cheap with a 4.6% dividend. Bank's been around a very long time. They're not going anywhere. Just to pull this up here, you can see their assets, total securities are about 8% of assets, well below the industry average. So, headlines, you can ignore that. If you come over here, I'm just going to have to pull my little picture away. It's 81% of all deposits are insured. So insured deposits, and remember, securities losses and uninsured deposits, that was the big danger according to the instant experts. They don't exist with this bank. Lots of capital, Tier 1 capital ratio over 18, well in excess of its peers, which is well in excess of regulatory limits, primarily single family loans. HomeStreet Bank is a multifamily lender out of Seattle. They have branches in Oregon, California, and a few in Hawaii. I love the Hawaii banking market, by the way. Really kind of finite real estate supply. These guys are a multifamily lender in a very big way. 57 branches, $9.3 billion in assets. They had hoped to go over 10 billion this year. Might not happen now. We'll see what happens. They had bought some branches that added a bunch of assets, but not sure they want to do whole bank M&A until later in the year. So I'm not sure they make it to the $10 billion, which is an important regulatory capital level. Stock has gotten absolutely hammered because of their exposure to Seattle, even though it's not a big deal. The expectation that commercial real estate is going to be awful. We could do 2 hours on commercial real estate. These guys are in multifamily, as you'll see in a second. They don't have significant, downtown office and that type of exposure. We're not worried about multifamily lending. It's going to be fine this year. 6 times earnings. That's 6.9 times depressed earnings. Earnings are going to take a hit. It's inevitable in the banking industry. Rates have gone up. There's going to be hits. Credit standards are tightening. Going to be hits. So earnings will be lower, but you're only paying, 7 times earnings, let's round up, and you're collecting a 7.5% dividend while you wait for anything good to happen. Remember, one blink of good news and these things are going higher. 14.75% securities, again, lower than its peer, 84% insured deposits, plenty of capital, 51% multifamily, a little bit of CRE, but not much, 16% first family loans, I did it again. Very little non-performing assets, so credit quality is fantastic. Then finally, we'll get in here so we can get this one in and get a couple questions in at least. Parke Bancorp, PKBK. This is in Sewell, New Jersey. That's south of Philadelphia. A lot of their branches and assets are in the coastal areas, well above average household incomes. 8 branches, 1.98 billion. Hey guys, this is a smaller bank, as you'll see in a minute. If you buy this bank, first off, A, it's way up on I think it's going to get taken over in the next couple of years list. B, it is not Apple. It's not Bank of America. Use a limit order. You're going to buy lunch for some traders, okay? Again, banks down, year to date about 15%, holding in there, 5 times earnings, right around 80% of tangible book value right now, a dividend yield of over 4%. This bank is just super attractive on so many levels. Now, jumping down, securities 0.94%, so way below the peer average. 60% insured deposits. They have a lot of very large transactional accounts. I didn't bother to do the deposit breakdown because I'm already running out of time, but they have a lot of large transactional accounts, very little savings-oriented accounts, over $250,000 in assets. So the insurance ratio is lower than the national average, but it's not a number I'm even vaguely concerned about. Primarily single-family homes and local commercial real estate lending, little bit of multifamily. Some 90-day past dues in commercial real estate, on average, still pretty low. And again, lots of capital with above average tier 1 capital ratios, and which both the average is well above the regulatory limit. So that's my presentation. Mark, do we have any questions there? We've got 3 minutes left to take as many questions as we can.
All right, Tim, thank you so much. We had a viewer here. They're wondering, when the larger banks report earnings, what do you think we'll learn?
We're going to learn. They're going to they'll take a hit this quarter. Next quarter's bigger. We want to know about deposits. We want to know how much primarily they've tightened lending standards. The reports, looking in the rearview mirror, you want to be on the conference calls or at least reading transcripts, because that's where all the good information is going to come out. The important thing from big banks is lending standards. How much did they tighten?
Excellent. Thank you. Another question here. If a bank has preferred shares, would you purchase those instead of common shares?
It depends on the price. We've actually been really active buying bank preferreds under $20. Most of them have a $25 par. We're buying these because when the industry calms down, we go into recession, the Fed stops raising rates at a minimum. At a maximum, maybe next year sometime they start lowering rates. These things will go back up towards 25, and we can collect 6, 7, and in some cases 8% while we wait for that. Been real active in that. make sure you love the bank, make sure the bank is safe, and don't pay over $20. And I think it's a great trade right now.
Thank you. Another viewer here, they're wondering, do you recommend any bank ETFs, or do you just stick with the individual stocks?
Yeah, and I'm allergic to ETFs. I'm old. I'm a single stock guy. I mean, I've got friends that own ETFs. I've tried to talk them out of it, but to each their own. But I'm not an ETF guy, so no, I actually don't.
All right, thank you very much. Another viewer here, they're wondering if are these three banks recommended in your 20% letter? And we had one viewer who was late coming in. They said they have the HMST and the TRST, but what was the third one?
The third one's Parke, Bancorp, PKBK. No, TRST is actually on my watch list. It's New York Bank. I think we may see a little bit more selling. We want to buy it a little bit lower. The other two, I decided to be generous. They are not in the 20% letter. They are in the bank takeover portfolio. We consider them, but that's another letter that we have at Investors Alley. They have the characteristics that could fit easily into the 20% letter portfolio. They're also trading at massive discounts to tangible book value. And I think that they're really viable takeover candidates. So they're in that portfolio. So you kind of get the best of both worlds with those two.
All right. Well, Tim, thank you so much. That puts us at time. Really appreciate you taking time out today.
I really enjoyed it. And thank you, everybody, for attending. I really appreciate it.
All right. Have a great one.
Thank you.
And a big thank you to all of those in attendance. We were just speaking here, Tim Melvin, the 20% letter. So be sure to check any information out on him and stick around. We have more great content coming your way. We have a few more sessions to close out the day. So don't go anywhere. Stick around. You're watching Money Show's Virtual Expo, Money Markets and Monetary Policy. Thanks for being here, everyone.